All right, let's get right into it. Imagine you've got a chunk of money to invest. But here's the catch. You can only pick one asset, and you have to lock it in for the next 5 years. Where do you put it? I mean, that's the million-dollar question, isn't it? Especially today with inflation, crazy innovation, and just a whole lot of uncertainty out there. So that's what we're going to do. We're pitting 4 absolute heavyweights against each other in a 5-year race for maximum profit.
So here's how we're going to break this down. First, we'll set the stage for this high-stakes race. Then, we'll properly introduce our 4 contenders, one by one. After that, it's time for the main event, a head-to-head showdown looking at the risk versus the reward for each. And finally, we'll get to the verdict and, most importantly, talk about what this all could mean for your own strategy.
You might be asking, why this question? Why right now? Well, think about it. The next 5 years are shaping up to be a real roller coaster. We've got inflation that just doesn't want to quit. We've got mind-blowing tech advancements like AI changing everything. And we've got this constant hum of geopolitical tension in the background. Trying to pick the right horse for the race has never felt more important, or frankly, more complicated.
So this is the question at the heart of it all. We're not talking about day trading or what's going to happen next week. We're looking at a serious time horizon. Think 2025 all the way to 2030. Which one of these titans is really poised to deliver the biggest returns? Let's bring them out and meet them.
Okay, I want you to think of this like a championship fight. We have 4 contenders, each with a totally different fighting style. In one corner, you've got the ancient, undefeated king. In another, you have the powerful engine of the entire American economy. Then there's the lightning-fast tech titan. And finally, the ultimate wild card, the digital disruptor that nobody saw coming. Each one has a legitimate shot at the title.
First up, let's talk about the ancient king, gold. For literally thousands of years, this has been the go-to. It's the ultimate store of value, the safe harbor in any storm. When markets get chaotic and people get scared, they run to gold. The big question, though, for the next 5 years is, can this old world champion really keep up in a high-tech, fast-paced race like this one?
Now this is where it gets really interesting. It's like a constant tug of war for gold. The bull case, the reason to be optimistic, is powerful. You've got central banks all over the world buying it up like crazy, trying to diversify away from the US dollar. Plus, stubborn inflation and global instability make gold look really attractive. But the bear case is just as strong. Gold doesn't pay you a dividend or interest, it just sits there. And when the stock market is roaring, the money you could be making there, that's a huge opportunity cost.
And to put some real numbers on that bull case, just look at this. This is a forecast from Morgan Stanley, a major player. They see a potential path to $4,500 an ounce by the middle of 2026. Now that's not just a number they pulled out of a hat, it's based on those big drivers we just talked about, especially that massive demand from central banks. That's a serious potential upside.
All right, next up in the ring, we have the American engine, the S&P 500. This isn't just one stock. It's a slice of 500 of the biggest, baddest companies in the United States. For most people, this is the stock market. It's the foundation of retirement plans, and it's basically a direct bet on the long-term growth and resilience of the U.S. economy itself.
The argument for the S&P 500 is, well, pretty simple and incredibly compelling. Just look at the history. Over the long run, it always goes up. The American economy is an innovation machine, and it always bounces back from downturns. The big catch, though, the bear case, is that right now stocks are kind of pricey compared to their historical averages. We call that elevated valuations. So there's a risk that a recession or some big global shock could really take the wind out of its sails for a while.
So what could that long-term growth look like? Well, the statistical models from our source material point to a base case target of around 8,253 for the index by the year 2030. Now, that represents that solid, steady, compounding growth that really builds wealth over time. It might not have the explosive, overnight fireworks of some of our other contenders, but it's reliable. It's the tortoise in this race. Our third contender is the real speedster of the group, the tech titan, the QQQ. This tracks the Nasdaq 100 index. Think of this as the high-octane, pedal-to-the-metal growth play. It's packed to the gills with the innovators, the game changers, the companies that are literally building the future as we speak, AI, cloud, you name it. The bull case here is almost intoxicating. The QQQ is hitched to the most powerful economic trends on the planet, especially artificial intelligence. And historically, its returns have absolutely crushed the broader S&P 500. But, and this is a big but, it comes with a major risk: concentration.
A massive chunk of this fund's value is tied up in just a handful of giant tech stocks. If one or two of them stumble, or if regulators come knocking, the whole index can take a nosedive. It's a double-edged sword.
So what's the potential reward for taking on that kind of risk? Well, it could be huge. The analysis we looked at projects a potential total return of over 67% in the next 5 years alone, and that's largely powered by that AI tailwind. For anyone who believes that tech's dominance is just getting started, that is an incredibly compelling number.
And that brings us to our fourth and final contender, Bitcoin, the digital disruptor. This is the true wild card. It's the asset that challenges everything we think we know about money. Some people hail it as the future, a revolutionary store of value for the digital age. Others dismiss it as a purely speculative bubble with no real value. But whether you love it or you hate it, you absolutely cannot ignore it anymore. The arguments for Bitcoin right now are reaching a whole new level. The bull case is incredibly powerful. First, you've got the new ETFs. This means massive institutions, we're talking giants like BlackRock, can now easily buy in, opening the floodgates for huge amounts of money. You combine that massive new demand with a supply that is programmatically designed to get scarcer over time through events called halvings, it's a classic economics 101 recipe for a potential price explosion. Of course, the bear case is just as intense. The price swings are not for the faint of heart, and the fear that a major government might try to crack down on it is always lingering.
And this brings us to what is, without a doubt, the most jaw-dropping number in this entire breakdown. According to ARK Invest, a major firm that's all in on disruptive tech, their high-end bull case for Bitcoin isn't a return of 50% or 100%. They're forecasting a potential growth of over 2,400% by 2030. I mean, a number like that just puts the sheer scale of the bet on Bitcoin's success in a perspective. It's in a league of its own.
All right, we've met the fighters. We know their styles, their strengths, and their weaknesses. Now it's time for the showdown. Let's put all four of them on the same page, side by side, for a direct comparison to see how they really truly stack up against each other.
And this table just lays it all out so perfectly. It's a classic trade-off, right? You can see this clear ladder of risk versus reward. Down at the bottom, you have gold. It's your defensive player, low to medium risk, but also lower potential profit. As you climb the ladder to the S&P 500 and then the QQQ, both the risk and the potential reward get ratcheted up. And then way up at the top, you have Bitcoin, offering the absolute highest potential profit, but it comes with that very high risk profile to match. There's no free lunch here.
Now, if we translate all of that into cold, hard numbers, the picture gets even sharper. This chart shows the probability-weighted annual return for each one, and what that means is it blends the bull, base, and bear case scenarios together. And wow, the results are pretty stark. Bitcoin's potential return of over 42% a year, it just stands in a completely different category. It absolutely dwarfs the projections for the other three assets, which, by the way, are still very respectable numbers themselves.
So, we've seen the contenders, we've seen the showdown. After all of that analysis, what's the final verdict? What's the big takeaway? And maybe more importantly, how can you actually use this information? Let's get to the conclusion and talk about some practical ways to think about your next move.
So what is the clear bottom line verdict from the source material we analyzed? It's pretty unambiguous. It concludes that based on all the converging factors, that institutional adoption, the unique supply and demand dynamics, Bitcoin presents the strongest case for the highest possible profit over this next 5-year window. It's a bold call, for sure, but it's one based on these powerful forces all coming together at once.
But here is the most important takeaway of all. Winning this race isn't necessarily about betting your entire life savings on the fastest horse. The smartest move is often to build a balanced team, and this slide shows what that could look like for a moderate investor. You see, the S&P 500 acts as your reliable core. The QQQ adds that powerful growth engine. Gold is there to play defense, and then a smaller, strategic allocation of Bitcoin gives you a shot at that explosive, game-changing upside, but without risking the whole farm.
Okay, so how do you actually put a plan like that into motion? The analysis points to 3 really smart strategies. First, dollar cost averaging. That just means investing a fixed amount of money on a regular schedule, say every month. It's a fantastic way to handle volatile assets because it smooths out your average price. Second, that core satellite approach we just looked at. And third, rebalancing. That's just periodically trimming a bit of your winners and using the profits to buy more of your underperformers. It's disciplined and it keeps your portfolio right where you want it. And so, we come full circle, but hopefully with a totally new perspective.
The real question isn't just about picking one winner. It's about understanding the unique role that each of these powerful contenders can play. You've seen the data, you understand the risks, and you've seen the incredible potential rewards. So the final question is no longer who will win. It's how will you build your team?